Hello and welcome to the PPW Podcast, bringing you news, views and interviews from the world of real estate, online marketplaces and proptech industries. My name's Harvey Hancock. I'm news editor at Online Marketplaces. I will be your host today. I'm getting good at doing this in one breath, Simon.
Good morning, Harvey, and it's good to see you again. And
Thank
I'm
you.
looking
Good to
forward
see
to
you
our
too.
today we call in Australia Around the Grounds, where we're going to sort of zip around a few businesses that put out their financial results over the last week or so and have a chat about how they're going.
Absolutely. I mean, there's only one place to start, right? And that's in the US, where there's been a whole bunch of financial results come out in the past week or so. So, where do you want to start? I think we covered CoStar briefly last week, so we could do maybe a quick check over of CoStar, and then we can get into the meat and bones with Zillow and Redfin and that lot.
Yeah, well, with clearly we talked about CoStar last week, and they had some good results that came out, but that's a very big business. And if we're going to compare Zillow and Realtor.com, we're going to look at Homes.com.
Absolutely.
Now, the challenge with Homes.com is, it's very hard to get below their numbers because it's sort of buried in all the numbers of CoStar. What we do know is that they came out of the starting gates, I guess, in sort of February this year, I think, when they started charging for their new packages, rolling out a sales team, and clearly this billion-dollar marketing campaign. And the question is, what financial impact has that had on its competitors? So let's look at the closest competitor that Homes.com has, which is Realtor.com. And
Yeah.
Harvey, do you want to sort of a brief overview of sort of what they've announced?
Yeah, so Realtor.com, obviously owned by Move, which is also involved in the REA group.
So News Corp.
Typically, News Corp.
Yes.
So basically, it's not looking good for Realtor.com, right? They're slowly losing market share, and they're also seeing their revenues actually starting to dip now. So I think it's about a 2 to 4% drop year on year from Q3 2023. So Move, which obviously owns Realtor.com, revenues of 140 million, which is down 2% year on year, while overall real estate revenues were down 4%. So this is a business that is not only being impacted by NAR settlements and changes to the lead diversion model, which we spoke about briefly with Brian Boero on a recent episode of the podcast, but it's actually having an impact on bottom line now, Simon.
Yeah, so I think the what we can read into this is the turbocharged competition driven by Homes.com, CoStar, is starting to eat into the competitors, not only at a traffic level, which if you look at what CoStar says that they are in number 2 place, that's according to them, but it seems to be what's more important is eating at the revenues. And I think, as you said, revenues have dropped 2 to 4% over the last quarter or year on year. Over that time, which is, it's got to be going somewhere. So my guess is that some of the agents are redirecting their spend from Realtor.com to Homes.com. And you'd expect that, right? Because Homes.com is running this massive marketing campaign. It's in the faces of consumers, but also realtors in the US. And that's got to be leading to an outcome that is, generating revenue. And I tuned into the CoStar market update, the call that Andy Florence did, it must be about 3 weeks ago now. And, the big challenge they've got is just scaling their sales team. Now, that's probably a pretty good problem to have, right? It means there must be demand for the product, out there. And if you can scale the sales team and deliver the results, then, that $1 billion of investment in marketing to really prime the pump and get, momentum going is starting to pay off.
I mean, is there an element of CoStar's internal sales team going to these realtors and basically saying, hedge your bets, spread your risk. We know you're listing on Zillow, for example, already. Obviously, Realtor sort of following in the path of Zillow in that it's reliant on the MLS. So come have a go at the other prong of the fork, shall we say, and see which one there's growth in there. Don't worry about Realtor.com anymore. Their history, their yesterday's news. The way forward is
Yeah.
CoStar, and we think it's better for you, Mr. Agent in the US, to be listing on Zillow and CoStar or Homes.com, for example.
I think that's part of it. I think your listing your lead approach is also having an impact. And if I'm an agent out there and I'm advertising on a Zillow or a Realtor.com and I haven't got my brand next to the listing, that's a problem, right? For me, as the person who's gone to the effort of getting that listing. And so I think this underlying approach that Andy Florence talked about at our recent Barcelona conference of being super agent friendly is paying off. And if I was in the sales team of Homes.com and I'm knocking on the doors of agents throughout the US, my message would be pretty simple. It would be, you see us everywhere, $1 billion marketing campaign. If you're not advertising on me, you're missing out on that traffic. And by the way, we're number 2, is what they'll claim. 2, this is your lead listing, right? So these should be your leads. So you want to put it over there, fantastic. Spend the money, put it there. But remember, the leads may go to another agent. So advertise with me. Your listing, your lead. So I think that is the cut through. You just start playing off the fact, that this is the way that you're going to grow your business, and you might as well spend the money on me and have the full benefit of having that listing on the Homes.com site.
Full year revenues for Move Inc. 712 million in 2022, 602 in 2023, and in line for 544 for full year 2024. Is News Corp thinking of divesting in Realtor.com and saying that we're not going to win this fight?
Who'd buy it? That's the first question, right? You're buying an asset that's going in the wrong direction. I don't have the top of my head how much they paid for it, but I'm sure it was not cheap when they did buy it. And the question is, the business today in 2024 is sort of the same size, not far off the size of the business was in 2020, and that was a COVID year. That's not good. Okay. So I think that, if I was internally there, I'd be doing a very serious rethink about strategy and approach. And what I guess the real question out of this is, if you're running the market leader like REA in Australia, it's pretty hard to stuff up. Right? You actually have to try really hard to get it wrong. Okay? But when you're in attacker mode, it's a very different game. And maybe News is struggling being in attacker mode. I mean, if we go back through history, they had Casa in Italy, and it went from number 1 to number 2. They got out of Property Finder in the Middle East, which is now $1 billion business, and they got out of that for chump change. It was sort of sub $500,000, and they had a 51% stake there. If I was a shareholder in REA, and we'll talk about REA in a minute, I'll be wondering, you've got all these investments in India. India is great. The revenues are moving forward, but it's not profitable, right? So then the challenge is, okay, how do I go from operating a market leader and the mindset about being a market leader and all the things you can do? And as I said, it's pretty hard to stuff up, and we've seen that in many markets. So, and then how do you be an attacker and have a different mindset and be far more, I guess, innovative and try to do some different things? And it seems to me that in the US, at least, with Realtor.com, they're struggling a bit.
They are struggling a bit.
Let's talk about Zillow. Leader, yeah.
Zillow, exactly. I mean, also year-on-year revenue growth, 581 million, above the midpoint of the company's outlook, Zillow says. Slight net loss. It's never made money as far as I'm aware. Zillow. But again, this, as Brian said, this is just an institution in the US, and even if it's running at a small loss, it's still clearly doing something right.
By the way, it's not a 580 million growth; it's 580 million revenue for the quarter,
With
and I think
17% growth. Apologies.
17% growth over the previous corresponding quarter.
Exactly. Year on
Right,
year,
so
17% revenue increase, which is pretty healthy for a big business like Zillow.
So that's interesting, right? So at the moment, it appears that Homes.com is not eating into that Zillow lead. So maybe what we're seeing here is a movement of spend away from Realtor.com to Homes.com. Realtor.com slipping to third. Homes accelerating ahead because they can afford to do it. And then it's becoming a Zillow Homes battle. Okay, and then the challenge is, how much money can both parties spend in marketing, and will the different messages or the different approaches, and there's a fundamentally different approach, your listing, your lead, versus a different approach with Zillow, which one will eventually win in the market? And so it's interesting, right? But still, they've always got a marginally profitable adjusted EBITDA. But adjusted EBITDA, then you get to the underlying numbers of, once again, it's not become a Rightmove. It's not become a traditional portal as we would expect in other markets, of one of which is generating, a 30, 40, even 50% EBITDA margin. They're just not there, and they really haven't. They've never been there. So once again, they'll continue to move ahead, play with the model. But I'm not convinced that in the US market, which is an MLS-driven market, you can ever really crack the code to get to a 40% EBITDA margin. Super hard.
It is super hard. I mean, the adjusted EBITDA, it's 100 million here, 120 million there. But this is on a business that's making billions and billions of dollars, right? So, as you say, margins are small.
Yes. So where should we jet off to now?
Well, I wanted to do a very quick follow-up on Zillow, which is if you scroll down on their Q3 filings, you've got the Zillow segment revenues, and it looks to me like the rentals and mortgages spaces are starting to very, very slowly creep up. This isn't going to be something that's going to necessarily change the game for Zillow, but considering that the lead diversion model, NAR settlement, is going to perhaps eat into the residential revenue, they need these segments to start performing bigger and better things, right?
Yeah. So if we do sort of a year-on-year comparison, Q3 2024 versus Q3 2023, and just look at the residential revenues, there's a roughly 10% increase of revenue from there, 362 million to 405 million. So I'll call that 10, 12% probably. If we then look at the rentals revenue, that's jumped up about 20%, maybe 25%. So that's where that strong growth is coming, is now 123 million. Now, I'm not as au fait with the US economy at the moment, but perhaps that's a reflection of more people looking to rent, okay, in that market. And mortgages, they seem to be getting a bit of traction there, but it's only up from 24 to 39 million. So what's that? That's a good 30-odd% increase there. So a lot of this growth is not coming out of the traditional residential side, but is actually coming a bit out of rentals and mortgages.
Absolutely.
It'll be interesting how this change of president in the US with Donald Trump coming back impacts the real estate market. And I think as people will theorize, and we probably should do a episode with Brian on this, assuming he's recovered from the election, to talk about what this potential impact could be. And then I think it would be useful for us to get a couple of players from the US to really talk about what the likely impact is going to be, and what this therefore would mean for a Zillow, for a Homes.com, and for a Realtor.com.
Okay. I'll get on the phone to Donald Trump and I'll try and get him on for an episode of the podcast, Simon.
Yeah, good luck.
Um,
That one.
Shall we do Redfin portal
Yeah.
and brokerage? 15 consecutive quarters of net losses.
I know that's a hard one to swallow if you're an investor.
Yeah.
15 consecutive quarters, and I think the challenge around that is, can they ever really turn it around, or are they just in this loop? Right now, what was interesting is year on year, quarter three revenues have grown. So Q3 2023 was 269 million. Q3 2024 was 278. So you've got a
3% increase.
Yeah.
It's
very
basically
little
flat.
increase. Basically flat, and the losses are a little bit more. Okay, it's hard. That's a hard game, running a business that's all about generating sales, paying salespeople, and trying to capture a small percentage of that commission. Okay, super hard. And if I'm looking back here, back to Q3 2020. In fact, Q3 2020, if we go back all the way then, okay, they had 236 million of revenues, and they've got 278. So, you've been working at this for 4 years, and you've added fundamentally 40 million of revenues, or what's that, 10%, 15, 20% maybe, in that range. It's a lot of work to fundamentally not make a lot of progress over 4 years.
And the thing is, I'm also reading here, market share dips to 0.76% of existing home sales by unit. So they're not even retaining market share. Yes, it's mostly flat, but when you're playing with small margins like Redfin are, any downward number is not a good look, is it? Especially in a slow market.
Yeah. Sorry, that was a 20% growth. I think I might have said 40%. That's a 20% growth over 4 years. That's not good. That's actually less. Quick calc, 18. So then I was having a look at their mortgage business, and another one, 33 million to 35 million over a year. Marginal growth. I think the question is, is this more of a reflection of the US real estate industry? High inflation rates over the last sort of 18 months has led to, harder for people to get mortgages and so on, and maybe slower sales than historically have occurred? Or is this a reflection of the business itself? Jury's out. But once again, Redfin's a hard one.
I mean, brokerage business is fantastic in boom conditions, right? And it's an absolute nightmare if you're in recession and bust. And it's been a long time coming that there's a lot of businesses that are waiting on a boom and upturn in global economies worldwide. You see it everywhere.
Yes. In fact, I was just looking back, and in Q4 2021, which is sort of like a high point for them, they had 650 million in revenues. And that is more than halved to 278, so 280 million in revenues today. So your business has gone fundamentally backwards over that point in time, over that period of time. Now, the housing prices, best to my knowledge, have not decreased, so it's got to be a volume of sales issue, which means you're losing market share.
I think Brian said on the podcast, I mean, there's just millions and millions of people going after so few listings. The market is just slow to a standstill, basically, especially during an election year. Nobody wants to, take a punt on interest rates or whatever it may be.
No, and I've got a feeling that if the next administration puts through a bunch of these tariffs on imports and so on, that's not going to help inflation. In fact, it might have a reverse impact on inflation. And then, if the rumors are true that they want to then basically bring the Fed, which is external from the government, and they're going to try to put it under the government and dictate what the inflation rate will be, that usually ends up in a bit of a car crash, which I think will then ripple through to the housing market over the next sort of 2 to 3 years. So if I'm a Redfin shareholder, I'm probably selling my shares. Okay.
Yeah, I was going to say the same thing.
I can't see. In fact, I probably would have sold them. I probably never would have bought them, to be honest.
And what about, would you be buying or selling Opendoor shares at the moment?
Well,
78 million losses for the iBuyer for the quarter, and they've just announced 300 job cuts in response to Q3's filing. They've made like 1,500 people redundant in 2 years, which shows that this is a business that's way bloated, right?
yeah.
In
Well,
really
bloated
slow
and the
market.
models. And the model's
Yeah.
not working. So just a quick check of the Redfin share price. It's
Oh yeah, go for it.
since a high point of $96 back in February 2021, it's lost 90% of its value, down to $9. So yeah, as I said, wouldn't have owned the shares. As for Opendoor, man, if you're once again, they're another one who've really not delivered results against the model. Okay, and if now they're having to slash its workforce even more, that's hard, right? Because I think you've said here then 17% of the total workforce, third major round of layoffs in the last 2 years. And when it was in November 22, 550 staff, then 500 and basically 550 again in April 23, and now they're losing 300 in November 24.
Doesn't paint a pretty picture, does it?
No, well, the iBuying model, right? Yeah, it's very hard to make that work. Clearly,
I mean,
and
it's
if we have
a low margin model. If I'm
high
you've got
volumes,
risk management, you've got
high volumes, low margins, and a massive headache. Here's another even scarier share price, and I've got to work this one out. It's fundamentally lost 95% of its value as a share price since same high point, February 2021. Since that day, it's gone from a $34 share to a $1.70 share. There you go, 95% of its value gone. That's hard, right? And it's what's interesting is its market cap is 1.3 billion, which I find interesting. That's even worth that much. Off a total revenue of 5 billion. So it's actually worth about, what's that, 0.25 times revenue.
which
So
is I mean, the less said about that, the better. I mean,
well, the challenge is with this business, right? It's a cash consuming business. And your EBITDA here is, apart from a break even EBITDA at the end of for the 2023 financial year, where they broke even. You look just quarterly. It is no. Here we go. It's EBITDA losses for as sort of far as the eye can see, and it just got a little bit. The trailing 12 months, it's 173 million in the hole. You can't keep losing that money, and expect shareholders to fund it.
absolutely.
You've got to do something. So I think what we've learned in the last probably 4 or 5 years actually a bit longer, with the iBuyer model. And this is Zillow learned this and bailed out earlier, and Opendoor said, no, we're going to keep going, is that it just doesn't work. Buying, holding, renovating, reselling, it's not a business that works, and you have to scale it so massively and run it so efficiently to probably eke out a 10% EBITDA margin.
Yeah, absolutely.
It's just not worth it.
They narrowed their losses by 28 million, and that reduced it to 78 million of losses. I mean, they're having to work incredibly hard to lose less than 100 million.
Yep.
It's
Yep. And having a look at their share price chart for the last, say, 3 months, the market has said, well, it was about $2. Where is this? What's this here? We have $2.40. and it's dropped down to 170. So the market just doesn't care.
Not interested in Opendoor anymore. Not interested.
Nope. And I can't even see the volume of trades, but it's just people. I just don't get it. So should we move on to some better results?
Let's go for someone who's smiling at the moment, and that's probably REA Group. Revenues of 413 for the first quarter of 2025, 21% increase year on year, and shares are trading at an all-time high after the Rightmove thing. So they're happy. They're happy, right?
Well, they're happy and they're not happy, because I was having a look at the numbers just before, and first of all, you've got some good year-on-year revenue growth. Fantastic. A lot of it's coming out of the Australian market, so you're continuing to squeeze that lemon hard. Okay, but you can't keep squeezing it. And Andy Florence at the conference in Barcelona said if they keep growing their revenues at this rate for about 5 more years, they'll be charging 70-odd thousand per agent per year, which is just not possible.
I think it was 7,200 a year with a 15% increase year on year or something along those lines.
Yeah, so he projected
astronomical
out
numbers that just do not make sense, basically.
And what's I think is, if I was at REA and if I was back at REA, and I was looking at these numbers, I'd be a little bit concerned. And the reason I'd be concerned is the following: my share price is at $2. These are Australian dollars, $241. My earnings per share is $2.30. So I'm basically trading at 105 times a price earnings ratio. That's enormous. That's the market saying, well, we can see a lot more growth in this business. So then I step back and go, well, where's the growth coming? So let's look at the assets. We'll start with their 25% ownership in Move.com. Well, we've just talked about that going in the wrong direction. PropTiger, REA India, so PropTiger, Housing.com, etc. They've got good year-on-year 42% growth in revenues, which is great, but it's still not profitable as far as I can remember.
And not only that, but I also don't know if it's a clear market leader yet either. How far ahead is it than the competition?
So I don't know. We should do a deep dive into the Indian market.
Yeah, let's get Dhruv back on.
Let's get Dhruv on, and let's get Nikesh. Let's get the Nakuri guys on board, right, to talk about 99 Acres, because I think it would be interesting to do a deep dive there about how they're going in that competitive battle. But then you're sort of looking at the Australian business. Yes, you've sold out of Property Guru in Singapore, but then you've got to say, well, where else am I going to get my value out of this? Okay, now what they've really done is benefited from a domain sort of totally losing its way. Now that's not going to something's going to change there, right? New CEOs coming in. It's still owned by Nine. There's a good chance that it may end up being sold and purchased by someone else. And if that is the case, they're not going to sit on their hands and make this easy for REA. So I'm going, if I was a shareholder in REA with a medium-term view, I'd be a seller. Right? I would sell short, because I've got my view is that a few things are, 3 things I think are headwinds, maybe 4. One is you can't just keep getting more money out of population. It doesn't actually work that way. And sales in Australia have dried up at the moment. So it's a much tougher market. Second, a revitalized domain is not going to go further backwards. They're actually going to move forward. And if moving forward means that revenue's got to come from somewhere. Third, View.com, under the leadership of Anthony Catalano, who knows what he's doing, is going to start eating away at some of this spend by REA. In fact, he was telling me a great story about some developers in Queensland who came off REA and saw no change in outcome. They just found a different vehicle that they could use and they got the sales done, and it didn't matter. So I think as you keep sort of really extracting a lot of value from your clients, people are going to find different ways to get the leads. And if they get the leads, then they will capture. The REA will face a headwind in that. And then I think the last thing that no one knows the real impact of is AI and how that can fundamentally change how real estate agents do their job. And we're going to do an interview in the next week or so with Mal McCallion. And I've been working with Mal on what does real estate agency of the future look like? And we're trying to think forward 2, 3, 4, 5 years. And we've got a pretty good articulation. And the view I'm coming to is that it's going to put a lot of pressure on the portals, because it sort of goes from being, I have to put it there because it's there, and I don't really follow the results and performance. I just get sort of leads and sales, to a far more nuanced approach by the agent, who's going, well, if I'm selling a house that's going to be bought by a 25 to 30-year-old young couple, they may not be looking at the REAs of the world. They might just be on social media, and maybe I need to shift my marketing plan to target them. So we're going to have a chat with Malcolm about this, and I think it's a bit of an eye-opener, is the way I think about it. Now, the other thing, in the old category of on the gossipy grapevine, the rumor has it that REA may be looking at Trade Me in New Zealand as an acquisition, which would be very interesting, right? They had a crack at Rightmove in the UK, didn't work. So when the share price went down, since that, it went down to 190 odd, it's now up to 240. So the market's going, okay, great. You can squeeze more value out of this lemon, and we can then give more return to the shareholders. But you've got to do something with that money. And so I think we have to keep watching this space, but the rumor may be right. Maybe REA is looking at buying Trade Me in New Zealand, which would open up a new front. Used to be in New Zealand many years ago with real estate. With I don't remember what we called it. That's too long ago now. Okay, but I think there's a chance they may clearly get into that market. But if you do get into that market, you're not only buying a real estate site, you're buying a general horizontal site, which is a very different business.
Well, that's the question I want to ask. I do want to get onto Rightmove before we wrap up, but one question on this REA rumor. Why would a real estate specialist like REA want a horizontal, though it's going to have to start looking into machinations that they've never had to do before? It seems a bit counterintuitive to me. Why not go for realestate.co.nz and know that you're going for, I know it is industry backed, but at least it's a specialized real estate platform, right?
Well, I think first of all, it's NZ, okay, not NZ. So let's get that one straight. I think a couple of things. One is you're not going to buy a number. If you're REA, you've probably learned the lesson. Hopefully, you've learned the lesson that you know how to drive a market leader. You're not really good at driving an attacker. Right? Because where have they done a great job in attacker mode? Right? The answer is they haven't. So therefore, you could probably argue that REA India is, but I think Dhruv is an excellent operator there. Two is New Zealand is sort of an extension of Australia. Sorry, guys, in New Zealand, but it's the same real estate brands that are in both markets. It's about a 5 million person market, so it's the size of Victoria. It operates the same way. It's a vendor paid advertising market, and so on. So it is for all intents and purposes something that they're comfortable with. Now they've learned that if you're the market leader and you're driving out of the front of the car, right? So you're market leader, you're driving, you're looking forward, you don't care what's happening behind. That's what they did with Domain. They just ignored them and drove. Then you're going to buy the market leader. Now, to buy the market leader, you've got to also buy this other stuff that comes with it. So I think, watch this space.
Yeah.
You heard it here first, which
first.
we'll cut if we're wrong.
Let's go over to the UK before
Yep.
we get out of here. Rightmove membership numbers not growing as quickly. As always, its revenue's increasing. I mean, that's just Rightmove in a nutshell, basically. But they're basically highlighting some slowed growth. Is the law of diminishing returns starting to set in for market leaders like REA and Rightmove?
Well, not REA, because remember, they're passing the costs. Vendor paid advertising, they're passing on to this home seller. Okay? So that's why they've got a 20% year-on-year growth. Rightmove is sub 10. The challenge Rightmove has is, I think, sort of three or fourfold, and we chatted about this during the acquisition attempt anyway, is one is you're the clear market leader in the United Kingdom, sort of daylight, okay? Two, you've got a well-funded on the market starting to attack. Same concept as in the US, so I think that might be pulling some of the spend out of Rightmove and redirecting it to on the market. I think three, you're already capturing a fair percentage of the agent's commission, so you can't. If you're doing, and depending whether you talk to a Jonathan Turpin from AIM Group or a Malcolm Myers from European Internet Ventures, you're somewhere between around that 8%, 10% sort of spend of the agent. Sorry, the commission of the agent is going to Rightmove. Well, you're not going to get to 16 and 20%. Okay, so you are starting to bump up against a roof. I think on the market is doing a good job in the UK. Once again, you've got a well-funded shareholder, very focused, driving like mad in the right direction. The team there is doing a good job. So I'm sitting there going, yeah, it's getting harder. And of course, when you've got most of the agents in the country using you already, it's hard to sign up more agents. The only ones you're signing up are those who are probably entering the market for whatever reason. And that's not an everyday occurrence. And then you've got to look at the macroeconomic environment in the United Kingdom, which is not the best on the planet. Okay? That makes it hard as well. And affordability is challenging there as well.
I mean, $1,500 a month ARPA for Rightmove. Basically, agents are spending £1,500 a month just to list on Rightmove. It's incredibly expensive. But you do have to admire the ability of Rightmove to keep getting people to pay this money and spend this money, and they're creating new product ranges, new packages that up the ante ever so slightly every time they innovate with these new products. So clearly there's still a big appetite from the agents to be paying this money.
Yeah, I'm not
to a certain extent. Obviously, maybe they're not happy about it.
No, I don't think there's an appetite. I don't think there's an appetite to pay it. What's really happening is, if you want to win a listing in the United Kingdom, you have to have Rightmove on the marketing schedule, because the consumer doesn't know any different. Now, and I talked before 80%, about
80% of portal traffic going to Rightmove in the UK. So it's just
so
it's essentially a monopolizing factor, basically.
Yeah, but I do think, and this is when we chat with Mal McCallion from Model Prop about his views on that future. I do think that the role of the portal will become less, and I think also the curtain will be drawn back for a lot of portals in the world about their true efficiency. Okay. Because the interesting question is, if the portal didn't exist, would homes still get sold? The answer is yes. It may not be as efficient, but it would still get sold. So I'm not convinced that the portal are driving sales. They're just making the process a bit more efficient and helping clear the market a bit more efficiently. But if another process comes along that achieves the same result and makes it even more efficient again, but at a lower cost, the portal doesn't have a leg to stand on.
The
So
portal
if
will
I'm
have to
sitting,
have the portal would have to have some kind of ridiculously amazing consumer experience end to end, close the entire transaction on one platform, and it would have to be. You see a couple of challenger portals that are like that, but we've not seen a market leading portal that
yeah, and
has
I'm all.
absolutely nailed the transaction from start to finish. I don't think.
By the way, I'm not convinced that a portal providing the capacity to close the complete transaction online actually adds a lot of value. How often do you buy a house? Now, it's not like I'm doing it as a weekly transaction and I need efficiency from a personal perspective, right? Because it's just I'm wasting time on an inefficient process. If I'm doing this once every 5 to 10 years, the inefficiency is not something I'm going to really care about. I actually like the fact that that's a detailed process because the inefficiency in the process and the people in the process gives me comfort that I end up owning the outcome. Okay. And I think there's something in that. It's a counterintuitive thought, but I'm not convinced that, wow, building a business that is amazingly wonderful with a super efficient process and everything is online and you click a button here, click a button there. I've just transferred $1 million or not $1 million, maybe it's 200,000 of my life savings and the bank has put in another 800,000. And I was like, okay, that was easy.
Too easy.
Too easy. Okay. And then and so I just got a feeling that something about the inefficiency in the market may give us more comfort, may give the consumer who doesn't eat and breathe this stuff every day more comfort. Anyway, we're getting knee deep in this stuff, and we've got more to get through next week.
We've got even more. We've got at least 4 or 5 more companies that we want to look at. So we'll call this the end of part 1 and look forward to part 2, right, Simon?
Yes. So thank you very much, Harvey.
Thank you very much, Simon. And well, I'll give the proper outro because it's tradition at this point. So until next time, it's going to be goodbye from Simon Baker.
That's goodbye from him.
And it's going to be goodbye from me. Thanks.